Hi looters, welcome back to Tick to Loot market updates for July 30th, 2026. We've got a packed agenda, a quick look at yesterday's releases, today's key economic calendar, and the latest headlines shaping risk sentiment. First, a quick reminder. This video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Let's jump right in. Let's start with what happened yesterday. Germany's import price index was slated to dip 0.7% month-over-month, a reversal from a 0.7% rise in the prior period, but the actual number hasn't been posted yet, keeping the impact low. In Switzerland, UBS released its Economic Expectations Survey. Analysts had expected a reading of minus 25.0, yet the final figure is still pending. Again, a low-impact release. Across the pond, the UK showed a modest uptick in M4 money supply forecasts at 0.2% versus 0.1% previously, while mortgage approvals were expected to edge up to 57,000 from 56,000. Net lending to individuals was projected at £5.5 billion, up from £4.6 billion. Though these are low-impact items, they help set the tone for liquidity and credit conditions heading into today's session. Moving to today's calendar, the first headline is Japan's Consumer Confidence Survey. The forecast sits at 34.2, a hair above the previous 33.8, and the data carries low impact. Traders watch this number because confidence trends can hint at future consumer spending, which in turn influences the Bank of Japan's policy outlook. A reading above expectations could suggest a modestly more optimistic household sector, while a miss might keep the yen under pressure if risk sentiment stays fragile. Next up, French consumer spending for the month. Forecasts pointed to a slight contraction of 0.1% after a 0.5% increase in the prior month. This low-impact release is a barometer of household demand in the Eurozone's third-largest economy. A dip could signal lingering caution among French shoppers, potentially weighing on the euro if the trend persists, while a surprise bounce will be a positive surprise for the region's growth narrative. Also on the French docket, the flash GDP figure for the quarter is expected at 0.2% growth, reversing a minus 0.1% contraction in the previous quarter. Though the impact rating is low, the quarterly shift can influence market sentiment about the Eurozone's recovery trajectory. A modestly stronger reading could lift euro sentiment, while a weaker-than-expected output could add to concerns about the region's momentum. Now for a medium-impact event, Germany's preliminary CPI for the month. Forecasts are at a 0.7% increase, a swing from a minus 0.3% drop in the prior release. Inflation in Europe's biggest economy is a key gauge for the European Central Bank's policy path. If the actual CPI comes in above 0.7%, it could reinforce expectations of a tighter stance, while a miss might keep the ECB's next move in limbo. Traders will be watching the euro's reaction closely. Rounding out the Eurozone data, France's preliminary private payrolls are projected to stay flat at minus 0.1% quarter-over-quarter, matching the previous reading. While the impact is low, payroll trends can hint at underlying labor market health. A stable or improving payroll figure could support the case for continued consumer spending, whereas a deterioration might add pressure to the euro and to policymakers monitoring wage dynamics. Putting today's data together, the euro is sitting at a crossroads. German CPI will be the main driver, while French spending and GDP add context to the broader Eurozone outlook. Meanwhile, the yen may respond to its own confidence numbers and any spillover from risk sentiment. If the German inflation surprise leans higher, we could see the euro firm up, but lingering geopolitical tension might keep traders cautious. On the headline front, the United States announced a heavy wave of strikes against Iran late yesterday evening. Such geopolitical events often trigger a risk-off response, prompting investors to seek safety in assets like the US dollar and gold. While the direct impact on Forex pairs can be short-lived, heightened tension can keep volatility elevated, especially in risk-sensitive currencies like the euro and the yen. Analysts are also reevaluating interest rate expectations after this week's mixed data releases and the geopolitical flare-up. In the U.S., the market is digesting the recent comments on policy, while in Europe, the ECB's next move hinges on inflation readings like Germany's CPI. The consensus is that expectations remain in flux, with any surprise in the data likely to shift the curve for both the euro and the dollar. Finally, a quick look at commodities. Oil prices have eased off recent highs, giving the European session a lighter breath as the week winds down. Lower energy costs can ease inflation pressure, which feeds back into central bank narratives. While oil isn't a direct driver for Forex pairs, the broader risk sentiment it influences can subtly affect currency flows, especially for commodity-linked currencies. That's a wrap for today's Tick to Loot market update. Looters. To recap, keep an eye on Germany's CPI, watch the yen after its confidence release, and monitor how geopolitical headlines shape risk sentiment. Remember, this is educational content, not advice. If you found this useful, hit the like button, subscribe for tomorrow's briefing, and ring the bell so you never miss a market pulse. Catch you in the next video.